Good day, and thank you for joining Tyler Duncan, Realty Partners monthly podcast on this Friday, July 26, 2024. My name is Chad Tyler. I'm here with my colleague, Charles Shapiro. And today, just having wrapped up the second quarter of the year, we're going to give you a market update on the four primary asset classes in commercial real estate. So we're going to cover office, we're going to cover retail, we're going to cover industrial, and we're going to cover multifamily. And we're going to give you an update specifically in the markets that were most active, which is the Washington, D.C. market and also the Denver market. In addition to that, we're also going to share some national statistics so we can put those markets in perspective in terms of how they're doing as compared to the national market. So with that, Charles, you want to say hi? And also before we get into our topic, if there's any sort of high-level storylines that catch your eye, you want to comment on them, why don't you do that?
Sure. Hello, Chad. Hello, viewers. What's interesting about the markets that we're seeing is the amount of sales we're not seeing. I mean, sales are down by about 27% across all product types. It's really, really challenging out there. And, so why are we seeing, this reduction in sales volume? Well, the first thing is, interest rates are higher. The prime rate is what, about 8.5% right now. We're also, in an environment where, office is definitely a problem child property type. And I think that, the expectations between buyers and sellers, Chad and I, we talk about this a lot, that the expectations of buyers and sellers and where the market is going. So now everyone's waiting for interest rates to go down because that's the expectation. So people are holding off purchases until they see interest rates start going down. So, this is sort of the bad news, that we're seeing these problems over here. Also, one thing that I didn't discuss is that lenders, because their portfolios are hurting out there, they're really having a hard time. And what we said last month was that we expect to see a lot of properties come on the market. So they're tightening their underwriting criteria. It's making it more difficult to get properties properly financed. So, Chad, you got to give us some. Is there any good news out there?
Yeah, Charles, there's definitely some good news out there, in terms of some bright spots. And this is kind of more geared towards leasing and some of the fundamentals there. But for example, with retail properties, right now they boast the lowest vacancy rate at right around 4.1%. So they've got the lowest vacancy rate against the four asset classes or within the four asset classes. So in the industrial sector, nationally speaking, the industrial sector has shown the highest rent growth in the last 12 months amongst all the different product types. So it showed rent growth of 4.7%. And, despite a challenging pricing market, many of the major property sectors saw rental growth across the board based upon a recent report put out by the National Association of Realtors. Charles, why don't we switch gears and get into our update? Why don't you start off by covering the office sector and the retail sector?
Very good. Okay, first, going into office. The first thing that we're going to talk about are the vacancy rates. And as you can see, vacancy rates are continuing to go up. Now they're going up at a slower rate. The national vacancy just ticked up to 13.7%, but DC and Denver are both at 17%. And if you compare the markets to other markets around the country, DC and Denver are amongst the highest in the country. So that is something that's really a tremendous drag on the various markets. Now, in terms of absorption, we're still seeing negative absorption. And on this graph, you're only seeing DC and Denver because if we put in the national numbers, they get actually too big to put on there. It's just very difficult. But this is showing you that both Denver and DC are trending in the exact same directions. And if you see a graph of the United States, it's the exact same graph where there was, there was a little less negative absorption in 2022, and then it's coming back down again. But we're still seeing these big negative numbers, and they are a huge drag on the office market. Asking rents. Now, Chad made a very important comment that we haven't seen the growth rate in asking rents go really negative. You did for a little while nationally in 2021, but we're still seeing some very small positive growth. Now that should change, and we'll talk about that in a moment. So some final thoughts here about what we see going on in the office market. So we said earlier, the vacancies, the negative absorption, we expect these trends to go on for the next couple of years, until they find a balance in the marketplace. Now, what we said earlier about rents, expect them to go down. As you start seeing these distressed properties hit the market, get sold at big discounts, the new owners are going to be able to quote lower rental rates. And that's what we can expect to see here. And that's where you're going to start seeing rental rates going down until they hit a plateau, and then they're able to start coming back up. The reason why Denver and DC have been particularly hard hit is if you look at the employment force, a lot of them are able to work from home. Highly educated, high-tech type employees that can work from home. And so their companies are allowing them to. It enables them to cut costs because they can get smaller office space. And that's why you're seeing Denver and DC really top the country in terms of vacancy rates and in terms of negative absorption. The other thing that we're seeing is very low construction. DC, you're seeing historically low new construction. In Denver, the only real construction we're seeing is a very high quality Class A office. We've said this before, in the Rhino areas and Cherry Creek. And that's where you're getting people that want to work there. And it is very, very Class AA office. So, Chad, before we run into retail, you have anything that you want to add to that?
Sure, Charles. I would just point out that in the office sector, and we've mentioned this before, but the asset type that's getting the most leasing activity is Class A offices. There's a flight towards Class A amongst the tenants. In addition to that, in our last podcast, we spoke to this, but our expectation going into the balance of this year and into next year is that sales volume for office properties is going to increase because lenders are getting more aggressive in taking those properties back. So we'd expect sales volume to tick up there. So those are my only thoughts on the office sector, Charles.
Yeah, it's going to be really fascinating to see exactly where this goes. And are we going to see more of a flight to the suburbs where it's less expensive parking, it's less expensive for employees to work out there? And, you're seeing that in some markets. We have seen it out here in Denver a little bit, and in DC, where they're moving away from the most expensive markets. But it's going to be a very interesting process over the next couple of years. So let's move on to retail. Retail is a completely different animal. And one of the challenges is that especially since COVID, a lot of developers don't really know what the heck to do with the retail. They're not going to be building new malls because they don't think that people are going to be doing shopping at anything but the most popular Class A malls. So we're just not seeing it out there. So what we're seeing in terms of vacancies, really, really historically low vacancies. I call this full employment because can it go lower? Yes, but it really means that there's nothing, and there's going to be some sort of pressure to add more supply because people just can't find space when vacancies are in this high 3%, high 4% range. On net absorption, we've had positive net absorption. And as you're going to see on the next slide, it's been really, really good. I mean, see where it was negative over here. That was all COVID negative absorption. And so we've seen positive net absorption nationwide and very strong, net absorption here in Denver. A little bit less strong over in the DC area, but it's a bigger marketplace. So we said earlier about the fact that these are strong. We're talking about in DC, all the last 11 quarters, there has been positive absorption. All the past 12 quarters in Denver, and in, I believe, all the last, actually, I think it's more like 11 of the last, 12 of the last 13 nationwide. But we've just seen it's been persistent. It means that there is no doubt that companies want retail space, but nothing's being built. And the other thing that we're seeing is when COVID came along, you saw a lot of retailers close. Everyone knows of all the restaurants that closed, all the retailers that closed. Well, guess what? We're now seeing a reduction in tenant move-outs due to closures or bankruptcies. That is really, really good news. But the bad news is that you don't have new space to put them in. And there's no new malls, there's no new big retail. So what we have seen on the retail side is build-to-suits. So you go down the highway, and here in I-25, you're going to see, properties going up, but they're single-tenant individual properties, and that's what we're seeing most of out here. Rent growth, and Chad said it earlier, the rent growth on retail has been really, really powerful. I mean, 4%, 3% nationwide is really solid. And of course, that's because there isn't any, more space. Now it has slowed down a little bit, but we expect this to be a bump, and we expect rent growth to go right back up into that 3.5% to 4% range going on into the future. So, so the next thing is that with the fact that we see low construction, no new vacancies, no new space coming in the market, expect to see retail having low vacancies. Rental rate growth is going to stay healthy because supply and demand, and expect the retail market to be fundamentally sound over the next few years. But as we said earlier, you're still seeing this low volume of sales, and that's because of the global economic issues, not necessarily the fact that people are afraid of retail properties. So Chad, anything you want to say before we roll into industrial?
I would add, Charles, that the interesting storyline related to retail is that e-commerce has not had the negative impact that everyone expected it to have on the retail sector. I think we certainly didn't expect to be here today sitting with these solid fundamentals amongst retail properties. So in addition to that, I'd also point out that neighborhood shopping centers in particular have been performing very well amongst the product type. So those are a couple thoughts related to retail. Unless you have anything else you want to add on retail, I'll move into industrial.
No, it's just a fascinating thing that there's still big fear about building big retail as we get more into the e-commerce, and they do have a better understanding of what we need to build and what people are going to buy via e-commerce. So Let's roll into industrial. And Chad?
Yeah, so let's go to the next slide. With industrial on a national level, right now at the end of the second quarter, we're sitting with a 6.6% vacancy rate. And that vacancy rate actually has been ticking up for the last 8 quarters. So really for the last 2 years, we've seen modest increase every year of that vacancy rate going up to the 6.6%. So still really not a bad vacancy level overall. The DC market in particular, if you look at this chart, you see the national vacancy rate in blue, DC in red, Denver in green. And DC, the Washington DC metropolitan area is showing the least volatility, also the lowest vacancy rate, just over 4%. For Denver, it's really a different story. Denver right now sits at a vacancy rate of about 8%. It's been there for several months, or a few months anyway. And that's really because
Charles, I think we lost Chad. Do you want to take over from here?
Sure. So I think we lost Chad for a minute, so I'm going to jump on in. And you're seeing that Denver's up to 8%, and you might think that is an unhealthy vacancy rate, but it's really because a lot has been built, and that Denver has been such a big engine of growth on the industrial side. Moving on over to national absorption, you can see national absorption is healthy. Look at the absorption that happened due to COVID. And that's where you saw the big absorption heading from COVID. Leasing momentum has begun to even though in the last quarter, we've had little net absorption, it's not terrible. So we expect nationally the vacancy rate to top out about 7% in mid-year 2025. 497 million square feet of delivered space represents, a record high. So we are delivering space. However, the new construction pipeline has dropped off sharply, which is going to lead to lower vacancies and higher rental rates. That's especially what you're seeing in Denver, is that it's coming to a stop. And that's why once these spaces get leased up, you're going to see rental rates go back up. So here's the net absorption in DC. Now it's really interesting because DC and Denver are very, very different marketplaces, where DC really has a lot of data hotels and telecom. Denver has Amazon and companies like that are out here. But look at the net absorption. They're really, the same. And DC has been so strong for so long. And we expect that really long term to stay the same. Rent growth. When you're seeing rent growth like in 2022 of 10%, which is what, by the way, the series one is DC, series 2 is Denver, series 3 is national. But rent growth is slowing, but it's really a pause more than a trend. And I think that is a great line that was written by Chad, and I agree totally with him. It's more of a pause than a trend. It's just taking a breather in what's been a really, really healthy marketplace. We talked about under construction. Nationwide, the pipeline is going down, but it's going down to pre-COVID levels. You can see, it's sort of a mountain going up and going down. Denver numbers are slowing a bit too due to higher vacancies, but we're not really concerned. It's supply and demand. Under construction. So you can see this is the one market where you are still seeing construction through Denver, through DC. Denver, it's coming down a bit, like I said earlier, and that's simply a supply and demand issue. They've got to eat up through the supply, bring the vacancy back to a decent level. Chad, do I see that you're back with us?
Yeah, short-term internet issue. Apologies for that.
I'm going to give this back to you since this is your presentation.
Yeah, cover construction, Charles, or no?
I said a little bit, but why don't you go on? You probably have a different insight than I do.
Okay, yeah. Looking at the last bar chart here at the end of the bar chart, basically right now in DC, we have just over, at the end of the second quarter, around 12 million square feet under construction. Denver in the range of about 5 million. And I think the important point here is that for both markets, construction has trailed off considerably, as expected. There's been a fair amount of inventory, record inventory really added to the market, both for Denver, Washington, D.C., and the national market. So again, it's not unexpected to see construction trailing off with vacancy rates ticking up a little bit and rental growth slowing down. Switching gears, we're going to look at industrial sales. Charles had mentioned earlier that overall, with all four asset classes, the overall market in terms of year-over-year sales volume was down by about 27%. So looking specifically at industrial, this chart shows that pretty well. If you look at the orange bars, that's the sales volume there. This is on a national level. The blue line is price per square foot. But right now, at a national level, the second quarter of this past year, we're about 15 billion in terms of total sales for industrial product on a national level. Going to our next slide, looking specifically at the Washington, D.C. market, again, you can see that we hit in around 2021 mid-year, hit a high in terms of sales volume of industrial products. And then looking at 2024, right now we're sitting at about, for the Washington, D.C. market year to date, about 600 million sales. Again, looking at year to date 2024, we're at about 300 million in total sales for industrial product. And again, you can see the peak there in Denver back in mid-year 21. But largely, if you look at the blue line with the price per square foot, I mean, for the most part, while it's trailed down a little bit right now as of 2024, it's going to quickly jump back up, and the reduction has been, very modest in the scheme of things. So to sum it up, on the industrial sector, nationally, we hit a record high amount of inventory that was delivered to the market in 2023, and then a lot of that carried into 2020 in terms of, additional construction. Rent growth has slowed modestly overall, both in the DC and Denver area, nationally speaking, but a modest slowdown. On a national level, year over year, we've seen 7.5% increase in rent growth. So long term, the fundamentals remain strong for the industrial sector. We all know that e-commerce is driving a lot of this growth, and that's the foreseeable future. And this lower level chart just shows the supply deliveries against demand. And again, it just shows that construction's slowing down. That's going to help prop up the rental rates and also keep the vacancy rates. Well, is anything else to add on industrial before I jump into multifamily?
I think that the industrial market is probably the healthiest of all the markets. There's an expectation of how the market is going to perform, and I think anything that we see that's on the slower end is just a hiccup. And I think you said that really clearly, and I just want to emphasize that I totally agree with the assessment.
Yeah, the industrial sector along with the retail sector. So switching gears, getting into multifamily. In the second quarter, we saw a real strong rebound in absorption in multifamily. So on a national level, we saw 170,000 units absorbed during the second quarter. And that's the highest level of absorption that we've seen since the third quarter of 2021. So there were 180.
Oh.
Yeah, he came back in before. Maybe it'll reconnect.
Just tell me what you want me to do.
Last 12 months. Switching gears, looking at the vacancy levels and rent growth. If we look at the chart to the top right, that's the Washington, D.C. market. And then down below is the Denver market. You can see that the vacancy rates over this last quarter, they've remained unchanged. And on a national level for multifamily, they sit at 7.8%. And that's important because the vacancy rates for multifamily, nationally speaking, and for the most part, particularly in the Denver market, maybe less so in the Washington, D.C. market, but they've been actually increasing pretty much every quarter, every year for like the last 3 years. Right now, the Washington, D.C. market sits at a vacancy rate of 6.8%, very healthy compared to the national market. Obviously below the national market, we said it was set at 7.8%. Denver actually sits at 9.7%. Even though Denver is at a 9% vacancy rate, somewhat counterintuitively, for the second quarter of this year, it actually had the highest level of absorption in terms of the number of units delivered. Looking at rent growth overall for multifamily for the trailing 12 months, we've seen rent growth of 1.2% on average, so not a very high level of rent growth. However, Washington, D.C. actually showed 3.9% in annual rent growth. So again, a very strong performing market overall compared to the nation, compared to Denver. Denver's annual rent growth was just under 1%, so about 0.8%. If you look at the graph to the right, you can see that rent growth was climbing up very sharply at a peak. It peaked out around 2000, mid-year 2001, and then you can see a steep decline in rent growth and where we sit right now at 2024 at the end of the second quarter. As we look at Washington, D.C., a little bit more rent growth, you can see, again, similar to the prior chart, Washington, D.C. peaked out at right around mid-year 2021 as far as rent growth, but unlike Denver, it's starting to climb back up quicker with rent growth. So if we go to this next chart, it's the same rent growth shown for the Denver market. You can see Denver is remaining kind of flat between beginning of 2023 into right now where we stand now. So not performing as strong as Washington, D.C. Under construction right now, nationally speaking, we've got 185,000 units under construction right now at the end of the second quarter of 2024. In the Washington, D.C. market, we've got 23,261 units under construction. And in Denver, we've got under construction and slated for delivery in 2024, we've got 14,000 units. Looking at multifamily sales year to date, on a national level at the end of the second quarter, we've had total sales of $30 billion of multifamily product. And that's the lowest transaction volume that we've seen since 2012. And that goes back to some of the points that Charles made at the beginning of the presentation. Higher interest rates are making it challenging to have the performers pencil out. Lenders are also more conservative in terms of lending. Also, there's a price gap between what buyers are willing to pay versus what sellers are willing to sell at. The sellers have gotten used to those low cap rates, which drive up the value. And they're kind of sticking at that pricing. So that plays into the lower sales volume. So in terms of per unit values, the sales that have taken place at 3.6% lower year over year. So it's a pretty modest decline in terms of valuations. Looking at the Washington, D.C. market in particular, the D.C. market saw for the trailing 12 months saw $3.5 billion in sales volume. That actually reflects a 59% decline year over year in terms of volume for the D.C. market. And the average sale price per unit was down 2.5% year over year in the Washington, D.C. market. Again, that's a very modest decline. Looking at the Denver market for the 12 months trailing, we've had sales volume of $2.8 billion, and that reflects a 30% below Denver's 5-year quarterly average in terms of overall sales volume for multifamily. And for the Denver market, the per unit sales price is down by about 3.5%. So just in terms of summary for the multifamily sector, we've had a 40-year high level of inventory delivered to the market, largely in 2023, but also carrying into 2024. So the new construction is slowing, but really it's a record high level of inventory. The Washington, D.C. market is amongst the top 5 best performing multifamily markets in the country. Denver, the supply has, in the last couple of years, supply has exceeded demand resulting in higher vacancy rate. But it's really a function of, Denver's been a very strong market in terms of population growth. So builders have sort of tried to get ahead of that and have delivered a lot of multifamily product. Also, Denver has, for the last several years, it's not been much of a condominium market because builders have more liability as compared to some other markets as it relates to constructing condominium projects. So there's been more emphasis on multifamily, again, reflecting the higher, level of supply. So counterintuitively, Denver actually through the second quarter of 2024 has actually shown amongst the highest level of absorption in terms of the number of apartments absorbed. So again, it's a little bit counterintuitive, but that just plays to the continued strong population growth here in Denver. Again, counterintuitively, even though Denver's multifamily market has a high vacancy rate, it actually ranked third year to date in terms of investment volume for multifamily product. So with that, Charles, before we wrap it up, anything you want to add to the multifamily sector?
I would not want to be a multifamily investor because it is so challenging. They look at Denver, they like Denver because of the growth that Denver has seen and they still expect to see going into the future. But they need a certain amount of rent growth to hit their numbers. And if things are a little bit soft, it gets really, really tough. But DC and Denver are both still fantastic markets. And since single family homes are so expensive in both Denver and DC, you still see these markets are growing and growing and growing. And we're going to expect the 9.8% vacancy rate to come down. You're going to see rents going back up in Denver. That's just a matter of time eating through that inventory.
Absolutely, absolutely. Well, that wraps up our market update today. As always, we appreciate joining us. And if you have any questions that we can answer for you on that information or anything else related to it, certainly reach out to us. There's our contact information. And we look forward to you joining us for next podcast.